Welcome to the Wealth Acceleration Podcast with your host, wealth coach Wade Reed.
Hey, Money Masters. Welcome to part 2 of this Family Bank Strategy podcast. Last time we left you with me sharing about my experience having this great epiphany about the stock market versus using whole life insurance, risk versus no risk, similar returns. And now we're going to allow my colleague Gary Pinkerton to share some of his story and the practical uses of how he implemented the strategy after having the losses he had in the stock market and starting to apply a proactive approach to his financial life and applying the family bank strategy. Guys, enjoy the second part of this episode. Let's get into more of that. Like you transitioned, you started to see these questions about what's going on with the stock market. What are the alternatives? So how did you find Pat Donahoe, who's the founder of Paradigm Life? And then what did you do from that point forward that's been so different? And what's been effective for you using this strategy?
Yeah. So, I found him as many of my original clients did in that we were real estate investors. We had gotten the bug and understood the financial power, the magnification that can occur with providing workforce housing. And so I'm still a massive believer, a massive purchaser of residential real estate. It's my biggest core holding. As another very quick aside in that hierarchy of wealth. So between those directly owned things that you have, real estate, businesses, your own career, and then the complete speculation, meaning there's, dozens of people between you and your money and it's operating in industries you don't understand up there, but, typically a basket of mutual funds or something. In between there is something called passive investment or syndication, where you might understand more about it. You might understand a lot about it. And the people who have your money. There's a limited number of people between you and your money. It might just be one person, or it might be, 3 or 4. You can go visit the property. You know enough details about it, or visit the business that you invested in or something. But you're passive, meaning you don't make the decisions. There's still people between you and your money. And this sounds a little negative, but anytime you take money that is in your hands and you hand it to somebody else, you have taken on risk. I don't care if it is your priest or your pastor or your parents. You have taken on risk because now somebody else is in control of some of your resources. And I'm not saying don't ever do it. I'm just saying understand that's where the risk comes from. It walks around on 2 legs and it has your money. Yeah. And so I pulled it down very viscerally, feeling in my gut. I needed to get it into my own control. And Patrick Donahoe enabled me to understand that was about control versus risk. And I didn't understand why I wanted to do it. I just knew I did need to do it. And I have had tremendous success. I mean, certainly tenants and toilets brings drama. Tenants who don't pay you or whatever the problem is, it brings drama, but it is far overcome by the fact that you can use prudent long-term fixed rate loans, which we couldn't get on my farm back in the day. And it caused us to go bankrupt with 20% interest rate loans for a period of time. Now you can get these smaller rates and you can lock them in and you can offset inflation. So when you're in a world of inflation and the entire globe is a world of inflation today, everyone has fiat currency, then you need to protect yourself from inflation, even low inflation. So you can buy gold, that works. You can buy land, you can buy cars. That's not a good idea, but unless they're collectors, but you can buy art, you can buy something to hold value. But if you buy real estate, crazy things happen. You only have to put 20% of the money in. And somebody will rent it from you. So you get cash flow, you get tax deductions, and it has universal needs. So I'm a big, big believer of that. I did an entire series at Paradigm Life on real estate and the pluses and minuses. So I go down that path. And I just and Patrick was advertising on a real estate podcast at the time that I subscribed to. And he was talking about how you could use other people's money to purchase all the real estate, including the down payment. And I said, that just can't be true. And so I talked to him and John Stewart at the time, another colleague of ours. And it just made fundamental sense. I mean, I was a scientist. I was an engineer. I did the math. John Stewart, our friend, many years later, when we were colleagues, he said to me, you scared me to death when we would have meetings because I knew you were going to ask questions I didn't know the answers to. But I just did the due diligence and it all made sense to me. And so I put it in place in 2011. I primarily used it for 2 or 3 years to fund all of that real estate movement that I was doing. Mm-hmm. And again, like your client, your banking friend and the guy who had done it for 25 years, I was getting the same experience. Like there was one thing that I could count on to always be there. And, over the years, I've developed a bigger and bigger appreciation for having a lot of liquidity and certainty and stability. I didn't have, I'd been an advisor 2020. I started in 2014. So 2020 and COVID comes around. I've got 35 doors for my personal properties and 6 years advising other people to maintain liquidity. And I had gotten myself in a little corner where I was maybe like 10% liquid, but we recommend 30 to 40% at Paradigm Life. And if you had 35 doors, you ought to be on the 40% side of that 30 to 40. But I wasn't, because I had just made a big investment in one of these syndications and these like indirect investment things. I was all in on those at the time. And so what happens is the mayor of every town I own real estate in says, hey, and we know you guys are hurting, so you don't need to pay your rent. And we just kept waiting. My wife and I were like bated breath. I know they're going to say you don't have to pay your mortgage either, but no one said that. And we checked with the banks and they were like, nope, you still need to pay your mortgage. And so my wife looks at me and says, how long is this going to last? And so I go and look at all my liquidity, surprise, it's all in the life insurance. And I had maybe 6 to 8 months, which, was okay. It was better than most people I knew, but it wasn't comfortable. And then a great thing happens. The syndicator who took my, at the time, like 500 grand said, hey, sorry, we got to send all this back to you because the banks are not giving loans in the middle of COVID and we can't close on this property. We lost the property. We're giving your money back. And now all of a sudden my liquidity jumps up and it was like God looking at me saying, did you get the message? Or do I need to teach you a different way? So, so it was kind of interesting. But since then, I've also gone up into that tier 3, passive investing, kind of halfway between where I was for 20 years and where I pulled back to be super conservative with my own assets. And what happened over the last 3 or 4 years, the economy with, what it was under the last administration, it was rough again. And a lot of those things went bad. And a lot of the people's character who had my money went bad. And so I had another bad experience and I'm back now to building my own portfolio. The great thing though, Wade, and maybe this is a conversation for another get together, is that through all of this, I also learned about being a business owner. And you and I have the pleasure of working with a great group of business owners. And they're just fired up about maintaining control over their own life, about adding value with widgets, not just real estate. Yeah. To me, it's super inspiring. And it's a way, I think, to get more bang out of your personal effort put into something. Like you can only get so much. Your property can only be so much nicer than the neighbors, the other alternatives to rent that they have available, but your business can be orders of magnitude better because of what you've put into it. And so to me, it's a more efficient thing. It's a little scarier maybe, but it's more efficient. And I'm excited about that.
Yeah. So I guess to summarize the story up to this point, you spent 20 years in the Navy, and then exited at 26 years of that career. Found Paradigm Life and Patrick Donahoe in 2011. Hadn't quite retired, I guess, at that point. Is that right?
That's right. About 5 years. In fact, I was an agent moonlighting on the weekends and at night for a couple of years while I was still finishing up my pretty low effort end to my career.
Okay. So you found such an interest in the product you had purchased, this whole life policy that was designed specifically to hold a bunch of cash, right? There's life insurance that's just plain vanilla whole life that doesn't accrue cash value very quickly. And then there's this way of designing it where most of the money you put in is cash value. And that's what Paradigm Life specializes in. And so you had started to apply that. And for a few years, started to go, oh, this could be my next career, right? And so is that what you're saying? You moonlighted as an agent representing life insurance companies before you actually formally transitioned. And so you're kind of hit the ground running as an agent.
Yeah, that's exactly right. I did. And, this is just another chapter in life, right? I don't know that anybody ever joins a life insurance agency or becomes a life insurance agent as a lifetime career path. And I'm not saying I'm going anywhere. I'm just saying that the thing that I needed to learn the most, and when I looked around to people I wanted to influence and help not go through the experience that I was passionate that I did not personally want to go through again either. Like I wanted to help people avoid. I wanted them to learn my lessons. I was passionate about teaching what I had learned. And just some basic personal finance lessons and how to gain control in your own life to live the life that you want. I call that agency on my podcast. And so I wanted to be able to teach people that. I needed to learn it first. And the best way to learn is to become the teacher, right? And so I was holding meetings with people primarily because I wanted to become an expert at it. And now I want to become an expert about starting businesses for family members. And so I'm just continuing to grow and kind of step to the next level, and bring teammates on who can help do kind of the initial meetings now. But yes, it was the thing that I was most passionate about that I was doing in all my free time. And so I said, why not, make it official and actually do it?
Yeah. Sounds like we have a little bit of similarity when it comes to the research side of our lives. I'm a very deep learner.
Oh, yeah.
I like to get into the details of things. And that's probably why it took me from 2009 to 2014 to fully grasp the value of a properly designed whole life insurance policy as an alternative to 401k, IRA type plans, providing more liquidity, more opportunity for investment outside of it. It's not just purely a place to store cash, but something you can collateralize. And this is why the term family bank comes in, guys. Banks, what do? They take our deposits, and in essence, that's their collateral, and then they lend it out to other people. But then they collateralize those loans through the cars that they take liens against, the real estate they take liens against, the business property they take liens against. So banks are very, very careful, very, very scrupulous about how they approach their investing. And again, for them, investing is lending money out to us and to the population of the communities that they do business in. So if we want to take a lesson out of the book of a bank, we need to look at that and go, okay, these alternative investments, whether it's a personally owned piece of real estate like a rental property or somebody else's business venture or their multifamily real estate deal, we need to get really clear on who those people are, do some background checks, make sure there's a good track record before we borrow against our life insurance. And if you don't have that yet, we can certainly schedule some time to discuss if that's a good fit for you. But if you have it in place already, and many of you probably do, you borrow against things when you have a really solid opportunity that's highly likely to be successful that adds additional value to your life. Now, a 5% return on a life insurance policy doesn't sound very sexy, but that's the net return. That's the net of cost of insurance. That's the net of taxes. So if you're looking at a 10, 12% return on a piece of real estate, you've also got some risk in there that's not really accounted for. And in reality, if you're a higher earner, that 5%, when you add back in the tax cost that hasn't been accounted for, it's more like a 7 to 9% return. So you got to find something that's very realistically going to be above 7 to 9% before you really get serious about investing in it. Otherwise, you just keep it in the policy. At least that's the conclusion I've come to. Have you seen similar?
I completely agree. I have a quick story on that. So I had a friend who asked me to invest in his real estate business, and I'd lent him money a couple of times. And so he said, hey, we're going to go buy some Texas land, subdivide the land, and sell it for people putting houses on. And so it was supposed to be about a 12-month hold, projecting like a 18 to 20% a year return. I felt like that was worth, taking my horses out of the barn, because if you can get a 9 to 10% return, then that's a 5% net, and you have some money left over to, buy the insurance or whatever. So I was like, you know what, that's worth it. So I was actually pretty excited about it because I wanted to learn land development. So what happens is, fast forward to the end of this story of a couple of months ago, like everything else, it went slower than anticipated. Interest rates went up. People that weren't going to go buy houses, et cetera, or buy land to build houses. So it was slower, sold for lower amounts than we anticipated. In the end, he emailed and said, hey, our internal rate of return was 20%, I think is what he says. And I'm like, hold on a minute. Internal rate of return is like an annualized return that you would get at a savings account. What I got was 20% more than I gave you over 2 years. That's a 10% annual return. It was more like 9.5. And so that's what the internal rate of return is. And he's like, okay, you're right. I meant total return. And he's like, but 20% total return is pretty good. I'm like, yeah, it's not bad over a year. It's okay over 2 years. It would be horrible over your lifetime, a 20% return on your money, right? Because time matters. That's one of the things that Todd Langford teaches us with Truth Concepts. So here I am at a 9% annual return, and the cost, and that was pre-tax. And so then we pay the capital gains tax on it, and we're down to about 7. Well, I had to borrow against my policy at the time 2 years ago at roughly 6%. So if you had said, Gary, will you borrow against your policy to get a net 7% return? Your cost of money is 6%. I would have said, no, the risk is not worth 1% to me. Right. If you give me an opportunity and a likelihood of getting 10% above my cost, I'll go put my money at risk to go do that. assuming assuming it's not my emergency fund and all these other things. But if I have
Right.
money, I'm looking for investment, I would do it. Right. And so this one looked like that initially, but in the end, it basically just covered the cost of the money.
Right. I think that's fairly common in these alternative investments where there's a hoped for return that's significant, as much as doubling your money over 18 months to 5 years, let's say. But then when you annualize the return and you consider the risk associated with that investment and some of the emotional turmoil that can take place, I mean, I've personally got one that's at an 80% loss of the money that I put in. That's one of these, it was supposed to be a slam dunk 15-month flip deal on a large apartment complex. It's just not gone the way we anticipated. The market just shifted. You can't anticipate that stuff. And these are risks that I had no idea to even think about. And it's just going to be a frustrating loss. I borrowed against my policy and I'm going to have to replenish that, hopefully from other gains on other investments. Of course, my own earnings as well you can replenish, but that slows things down. Too often, guys, we get sucked into investments that are not actually good investments. You don't really know enough about them. In fact, I have another client that just lost $75,000 on a syndicate. He was like, I didn't even know that was possible.
Yeah.
Yep. You can lose all your money.
So that's the easy button though, right? Like if we're looking in the mirror and we're being honest about it, like why would you not know that was possible? Well, because there was an easy button and they said, if you push that easy button, you get a 17% return. I've been getting it for 2 or 3 years. You should jump in too. And that was the level of due diligence. Yeah. I've done it. I'm not making fun of your client. I've done it lots of times. I've even done it recently. Shame on me.
Yeah. I think we get a little more, I don't know, we're so trusting of other people and we're trusting of circumstances that have been good in the past that aren't necessarily going to be good in the future. Yeah. And so no matter what the opportunity, we have to be scrupulous about it. Always underwrite the deal effectively before you say yes to it and look at all and in fact, I would suggest in a prior podcast, this guy named Andrew Wilson. That's right. No, not Andrew Wilson, Eddie Wilson.
Eddie Wilson.
We were both a few months ago. He talked about 5 key factors to underwrite deals. And guys, refer back to that podcast about how to go about the underwriting process. It's significant. We don't want to cut corners on that stuff because if we do, we almost always lose money. And if not, we just got lucky. So we're gonna. Do you have a thought there?
I just kind of a final takeaway from this, and it sounds like that's where you're headed. If possible, your least risk and therefore your highest chance for the greatest certainty to get to the financial future you want is to maintain as much control as you can stomach over your resources. Yeah. And I find so many business owners, because all they know is their business. They've had their head down in the business. They've been focusing. All of a sudden, not all of a sudden, like 4 or 5 years into the business, typically, it starts spitting off cash flow finally. They figured out how to do the business. They figured out how to market, and they've gotten the startup costs under control. Now the thing's spitting off money. And they're like, I'm so busy. I need to go put this to work somewhere. And if they don't meet with us, what they typically do is they go put it into somebody's syndication or they go put it into the markets. And so what I ask them is, hey, listen, let's say that you find out that you have this horse. You thought the horse was pretty cool. You take him out and you start racing him and you realize this horse has win the Kentucky Derby potential. Mm-hmm. And you have, a few $1,000s and you're racing the horse now. And you realize, I've got a few things I need to do. Which should I do? Should we, buy the better food or should we buy the cheaper food and instead put the money in a nicer vehicle to haul the horse around it? And so if you have a racehorse that could win the Kentucky Derby, put all the chips on that horse, right? Like move the thing around in Uber if you have to, but put all the money into making that horse do well. And that's your own business. It's your own real estate. It could be your own education to improve your ability to earn more money personally. But put the money there. And don't put the money in somebody else's business. I promise you, I have not seen Elon Musk's financial statements, but I'm betting you that if I saw his statements, they would have a bunch of liquidity. And on top of that, they would have directly owned low risk things that he's personally doing. Going to Mars, spending money to go to Mars, that's not low risk to most people, but Elon Musk is personally involved in doing it and making the decisions. Yeah. And so to him, rightfully so, it's low risk. Right. So I just urge everybody, take the lessons I've learned in my 55 years and bet on yourself and bet on things that you have some level of direct control in and maintain a lot of liquidity and you've got a bright future.
Yeah, bingo. Yeah, thanks so much, Gary. So we'll wrap there today, guys. The family bank strategy is about you having a lot of liquidity, enhancing that liquidity through a whole life insurance policy designed specifically for holding cash that then can provide asset protection. It can provide income protection in the event of early death. It provides legacy planning. So the guarantee of the death benefit passes to your heirs income tax free. It grows income tax free. It's accessible income tax free for any time at any purpose. In fact, we collateralize the policy so we don't actually remove money from it. So it keeps growing at the same time we borrow against it. And that's the hallmark of a good asset. An asset that can grow at the same time you have access to borrow against it. Real estate fits that bill. Businesses fit that bill. Whole life insurance fits that bill. And it's simpler though, lower risk than those other things. So we use it as the foundation of our financial life. We maintain, of course, some money in the bank locally for some emergency money. I keep at least a couple months worth of my expenses in just a local bank. The rest of my emergency fund is in my life insurance policies. And personally, I have 9 between myself, my wife, and my 6 kids. And Gary, you've got a whole suite of policies. About how many do you have?
We have 12 on a family of 4. Yeah.
So guys, it's not uncommon to have a series of policies that get accumulated over time because at one point you can only get a policy of one size. It might be 10, 20, 30,000 a year. My first one was 5,000 a year. And the next one, you have more resources so you can get a larger one. And you do that on family members. And over time, you just have a suite of policies that are your quote unquote family bank. And you have this resource now that can be drawn against for key decisions in your life. No government control over it. You have 100% control over how you choose to use those policies. There's no limitation on how much you can put in other than your own ability to do it. There's no early withdrawal penalties like there are on government qualified plans. There's no risk in the stock market at all. It's completely guaranteed in terms of the contract itself. So we use it as the foundation of this strategy and then apply it to the bigger picture of growing our wealth through other assets as well. So Gary, again, thanks for your time and joining me today. I hope we get to do it again.
Yeah, I love it. Lots of fun. That time flew by.
It sure did. All right, guys. So if you're enjoying this content, please take a moment to go review the podcast, share it with your friends and family. If you're looking at this on YouTube, hit that like button, subscribe to this podcast, and we will see you in the next episode.
Thanks for tuning in to the Wealth Acceleration Podcast. We hope the insights from today's episode help you streamline your finances and grow your wealth stress-free. For show notes from today's episode and more tips on creating a comprehensive wealth-building plan, visit moneymasterycoaching.com. Remember, financial freedom is attainable. Until next time, keep accelerating towards your goals. See you on the next episode.